Hey guys, welcome to my channel. Today we are going to talk about one of the most underrated factors behind building wealth. Not intelligence, not luck, but patience. When it comes to investing, many people have the skills. They understand where to invest, how to invest, which industries could grow further in the next 5 to 10 years, and how businesses would evolve. But many people lack is one of the most important investing skills of all, patience. For many investors, the biggest obstacle isn't a lack of income or knowledge, it's a lack of patience. We live in a world where fast money and making a quick buck are constantly glorified. But is that really a foundation of durable, long lasting wealth? Absolutely not. Real wealth often grows quietly. It's like planting a tree for years. It may seem like nothing is happening. Then one day, the tree has grown enough to provide shade. That's exactly how compounding works. Today, we will talk about why patience is so important and why it plays such a significant role in the mathematics of wealth creation. There are many myths about investing. One of the common myths is that you need to have a high income to become wealthy. Yes, if you have a high income, you could save more, but that's only one part of the equation. Another myth is that you need a lucky break, like winning a lottery. But even that is a real myth. What really matters is patience. Decades of investing history has shown that patience is one of the key factors that could help you to become wealthy. Let's take a simple example. Suppose you invest 25,000 every month and earn an average annual return of around 12%. While future returns are never guaranteed, diversified equity investments have historically delivered returns in this range over long periods in many markets. With that investment, after about 5 years, you could accumulate 20 lakhs. And after 10 years, 58 lakhs. And after 20 years, approximately 2.5 crores. And after 30 years, nearly 9 crore. And after 35 years, the corpus could exceed approximately 16 crores. Now imagine starting at the age of 25 and continuing until retirement at 60. A disciplined monthly investment combined with long-term compounding has the potential to create substantial wealth over time. There is no lottery here, there is no jackpot, there is no overnight success. It's simply patience allowing compounding to do its work. The problem is in mathematics, the problem is psychology. During the early years, compounding feels incredibly boring. You invest, you wait, nothing seems to happen. Then markets fall, there is an economic slowdown, the headlines become negative. Suddenly you begin to feel like you are losing money forever. Their biggest mistakes. They panic sell, they exit too early, they chase trends. These behavioral mistakes destroy far more wealth than a lack of investing knowledge. Almost every great investor has emphasized one simple virtue, patience. The basic idea behind investing is actually straightforward. Buy shares of fundamentally strong companies or invest in diversified asset classes. Hold them for a long term. Allow compounding to work. Eventually sell when it aligns with your financial goals. The logic is simple, but simple never means easy. Execution is hard. Being patient is hard. One interesting aspect of compounding is that it often appears slow during the early years because your investment base is relatively small. As your corpus grows, the returns generated on those returns begin to accelerate. That's when compounding starts to become much more visible. The mathematics hasn't changed, only time has. So broadly speaking, you don't need to be a genius. You need to be consistent. You need a sensible risk management strategy. Diversify across asset classes. Control your behavioral biases. Stay emotionally disciplined. In fact, an average disciplined investor who consistently follows a long-term plan can often outperform a highly knowledgeable investor who constantly trades based on emotions. Patience often beats brilliance. As I mentioned earlier, durable wealth is usually built slowly. Understanding the mathematics behind that process help you stay committed during periods when nothing seems to be happening. Long-term consistency always beats short-term excitement. Wealth that actually grows slowly tends to be more sustainable. So how can you apply this in practice? First, automate your investments. When your salary arrives, let a fixed amount automatically go to your investments, whether it's mutual funds, stocks, or any other suitable asset classes. Second, avoid tracking prices every single day. Many long-term investors find that reviewing their portfolio quarterly or even semi-annually helps to reduce emotional decision making. Third, increase your investments as your income grows. And finally, remain invested even during market downturns. Most fortunes are built by following a disciplined, often boring process consistently over many years. Don't give up simply because progress feels slow. Patience also reduces anxiety. You stop comparing yourself with everyone else. You make fewer impulsive decisions. You stop chasing and you start building. The mathematics is actually simple. Small amounts, long durations, consistent investing. That's a stable behavior. The world, your friends, your colleagues, even your own instincts may constantly tell you to move faster. They may tell you are already late, but investing isn't a race. Patience, when combined with discipline and sound investing principles, is one of the greatest advantages an investor can have. The real magic of compounding happens over years, sometimes decades, of disciplined investing. And that is what creates wealth that can support your retirement, help you achieve your biggest dreams, and even leave a legacy for future generations. Whatever your financial goals may be, patience remains one of the most valuable assets you can develop. So that's it for today's video. If you find this useful, consider subscribing for more long-term evidence-based investing content without chasing hype or shortcuts, because real wealth doesn't shout, it compounds. Thank you for watching. And as always, remember, this video is for educational purposes only and should not be considered financial advice. Please do your own research or consult a qualified financial advisor before making investment decisions.